Welcome back to StockScope. Today we are analyzing the massive correction in UnitedHealth Group. The largest healthcare company in the world has just reported earnings, triggering a violent 20% sell-off. We are going to break down the structural issues driving this decline, from margin compression to the 2026 outlook. Is this a fundamental breakdown of the investment thesis or a rare opportunity to buy a blue chip giant at a discount? Let's dive into the data. Let's get started.
The market reaction has been brutal. We witnessed a massive 16% intraday drop, one of the steepest falls in the company's history. Investors are panicking. The volatility index on this stock has spiked. The narrative has shifted overnight from safe haven to critical risk. Why? Because the market hates uncertainty. And right now, UnitedHealth's future profitability is a giant question mark. Here is the core problem. The medical care ratio, or MCR. This measures how much of every premium dollar is spent on actual medical costs. The target is usually below 88%. This quarter, it spiked to a fever pitch of 89.1%. This means the cost of treating patients is rising faster than the premiums UNH is collecting. Whether it is expensive surgeries, new drugs, or post-COVID care, the company is paying out more than it expected. In the insurance business, an overheating MCR is the equivalent of a heart attack for margins. Look at this divergence. Top-line revenue looks healthy, growing 12% to $447 billion. Batesiare Mticali's revenue growth is meaningless if you don't keep the profit. The net margin has collapsed to a razor-thin 2.7%. The company is moving massive amounts of money but keeping very little of it. This efficiency breakdown is exactly what Wall Street is punishing today. Q4 was a kitchen sink quarter. Management decided to take all the bad news at once. They recorded a massive $1.6 billion charge. This includes the final costs from the Change Healthcare, cyber attack nearly $800 million and costs related to exiting the South American market. They also booked provisions for lost contracts, admitting that some of their business lines were burning cash. Wow, painful. This clearing of the deck is designed to remove these weights so they don't drag down performance in 2026. Let's examine the insurance segment. UnitedHealthcare. The diagnosis is margin compression. Operating margins fell significantly due to government funding cuts from CMS Medicare. The regulatory environment has become hostile, and the company is struggling to pass these costs on to the government. This segment, usually a steady compounder, is currently the biggest drag on the portfolio. However, the Optum segment remains the life support. While insurance struggles, OptumRx Pharmacy Services grew revenue by 16%. This diversification is saving them. Optum is the technology and services engine that is less exposed to the direct risk of medical claims. Without Optum's growth, this report would have been catastrophic. Now, let's look at the treatment plan for 2026. The strategy is shrink to grow. Look at the revenue guidance, $439 billion. This is actually lower than 2025. They're intentionally forecasting a revenue contraction. Why? Because they are cutting off the gangrenous limbs. They are exiting unprofitable markets and dumping bad contracts. They are sacrificing vanity metrics like revenue growth to priorities, profitability. It is a painful but necessary strategy to restore health. The goal for 2026 is to get the MCR back down to 88.8%. Aggressive repricing. Insurance premiums are going up. They also forecast a reduction in membership by 2.5 million people. They are essentially firing unprofitable customers. By reducing the pool to only higher margin members, they aim to stabilize the medical cost ratio. Despite the earnings crisis, the patient has strong reserves. Operating cash flow is expected to exceed $18 billion next year. This is crucial because it means the dividend is safe. For income investors, this is the green light to hold. The company is not going broke. It is just going through a profitability squeeze. The debt-to capital ratio is also being managed down to 40%. We must remain cautious. The bear case is still active. First, sticky inflation. Medical costs might keep rising faster than UNH can raise prices. Second, regulatory risk. The DOJ antitrust investigation into the relationship between UnitedHealthcare and Optum hangs over the stock like a dark cloud. And third, continued CMS pressure. If the government cuts Medicare reimbursement rates again in 2027, the margin compression we saw this year could become the new normal. But for the bulls, there are recovery signs. First, valuation. The stock has reset to historical lows. Second, discipline. The right-sizing strategy usually works. Companies that focus on margins over growth often outperform in the following year. And third, secular growth. An aging population needs more care, and Optum is perfectly positioned to capture that demand long term. This chart asks the ultimate question: bargain or trap? We are seeing the PE ratio compress to levels we haven't seen in 5 years. If you believe the company can hit its $17.75 EP's target next year, the stock is trading at a significant discount to its intrinsic value. The market is pricing this as a broken business, but the cash flow suggests it is just a broken stock. Our final verdict: UnitedHealth is in critical but stable condition. A 16% drop clears out the weak hands. While the next 6 months will be volatile as they execute the shrink-to-grow strategy, we advise keeping a close eye on it. If you currently hold a position, continue holding it because of strong recovery expectations in the long term. This is a classic turnaround story in the making. Thanks for watching StockScope.